Hello everyone. So welcome to this video. I'm going to do my best to keep this as short as possible, but we are going to be talking about equilibrium and how we use it in trading. Let's get straight to the point. I have been working on an indicator for TradingView for myself that was meant to help me find a better two-step. So a two-step is a model that I use. I talk a lot about these in videos that I do. But what happened was, as part of this development, which I was doing myself, I ended up with something very different. Simply because I had a lot of bugs, a lot of issues I had to fix. In the end, the recipe ended up doing something very strange. You see, what you're looking at is a tool I built, which I now call the IB, the initiation block. What this tool is actually doing, and by the way, I'm still testing this tool, so it's not live. There's no waiting list. Um, there's no way to get your hands on this. But what this tool is doing, it's identifying equilibrium. So depending on the time frame that you're on, it's doing this in real time. So think about this for a second. I am not aware of any tool that you can find on TradingView that identifies equilibrium in real time. Yes, some tools do it, using legacy data or lagging data, and some tools, they repaint. This is real time. What does that mean? Finding equilibrium. Equilibrium is, think of it like fair value. So when you see price or you're looking at price, you can quickly determine based on some level of price that if price goes below that level, that price is cheap, so therefore you want to buy it. Or you can think of it in the reverse. If it goes below that level, you think, well, other people think it's expensive, so I can sell it, right? Again, this depends on your mental model. But it helps you establish if something's cheap or expensive. It's the same way you would determine if you were buying a car in an auction, right? You have a rough idea what their value is, so you would bid for the car as long as it's within a particular range, price range. In this example, I have the NASDAQ. Ignore the dashboard on the right hand side. This is me testing the recipe, making sure everything works as it should. Now, this is last week's close, Friday, and this is the 1 hour time frame. As you can see, we have an IB at 4 p.m. live. This, as soon as that candle closed, it said, hey, this level is an IB. So what does that mean to me? Well, based on this indicator, there are quite a few use cases, quite a few. And I'm sure you can think of some yourself. But basically, what the IB uh, does, it establishes two, well, it creates itself in two places, I've noticed. One is um, when there's going to be contraction or consolidation. I'll show you an example. Squeeze the chart like here. And the other is at swing points, so major swing points. So like here, for example, here, for example, here, for example. So they can quickly tell you where price will likely reverse, or where prices will likely consolidate. So a prime location for liquidity sweeps, for example. So you have one here where it says, hey, price is going sideways, you get a liquidity sweep, all these levels are swept right here. And then you get another trigger saying, hey, we are changing direction. So how would I use this? Like I said, there's multiple use cases, but effectively the way I'm currently using this, or testing this, is using price mechanics. So in other words, what I do is I wait for price to break out of that um, equilibrium level or fair value level. So it indicates to me which direction it wants to go. And then using price mechanics, I determine if I should join that direction. So in other words, a simple thing like a break and retest, I can use that, or I can use a breakers, I can use that, fair value gaps, entries, I can use that, liquidity sweeps, I can use that, right? So all of these I group as price mechanics. You have a mechanical way or some way of trying to identify direction. This also includes my model called two-step as well. I can use a two-step model to determine, right, is this going in the direction that I expect it to go, right? So like I said, price can reverse. So it can indicate reversals. So let's just use an example right now using this real life data. Let's assume that your bias is long. We now have an equilibrium level right here. That's telling you price is either going to just consolidate a little bit before it carries on its journey, or it may do a liquidity sweep at that level. So that's already indicating to you that that's a very important level, fair value level. So if I'm have a long bias, I'm now going to use that level to identify an opportunity based on my own price mechanics, right? Whether that's breaker, whether that's IFEG, whatever that is, right? So now I am watching for that thing to happen for me to then plan my trade, right? Now the reverse is also true. So if I have a bearish bias, again, your bias will come from your higher time frame, your weekly, your monthlies, etc. And we are currently in equilibrium, right? So again, this is the 1 hour. So this is a short-term time frame. So this you're looking at this in the context of a higher time frame, for example, the daily. But let's say I have a bearish bias, then I will use this level to identify an opportunity to then take a short position. So in other words, if price breaks lower, I will use my price mechanics to determine if I should take a short position. Now this works both ways. So sometimes you'll get obviously get trapped by price when price protracts. So price tends to go in this cycle where it'll contract, protract, and then expand. Contract, protract, and expand, right? And protraction can take different forms. Um, so it can take different forms, right? So it can trap you. Let's say you were bearish, price may break up, right? So you get aggressive buys jumping onto price, pushing it up, but they end up pushing price into aggressive sellers, and aggressive sellers then dump price back down again. This is where your price mechanics comes into play to understand when something is just a Judas swing, it's just a trap, and you can do that through your price mechanics. For example, I use volume, and I can see, hang on, this doesn't look right because either there isn't any volume at all, or there's extreme volume in that move. I will just step out and just go, hang on, I don't want to get involved because I want to see this play out. And that's what I mean by price mechanics. But understanding, finding equilibrium is something that you can't really do in real time right now. And this tool does that. What I want to do is really open the floor up to you guys to give me your feedback around potentially what you think the pros are, the cons are to equilibrium management types of trading. What do you think, in addition, this tool should do beyond just identifying the equilibrium level? So, for example, at the moment, I'm thinking of adding uh, things like a bull bear pressure gauge. I'm thinking of adding a go no go. Um, I'll say signal. I don't want to say signal, but condition to make it easier for traders to kind of manage their trades. Now, again, this is in-house. This is just for me at the moment. It's not public, and I don't know if I'll make it public. Depends on feedback. So let me know your pros, your cons, features. Also, if you have or have seen other tools like this that are useful, I can check them out. Again, I haven't seen anything that does this live, but if you found one, just let me know in the comments. But right now, all I'm doing is watching equilibrium. I did this for NDNQ, I did this for gold as well. Just before I go, let me just quickly show you gold. So on the daily, let's go to the daily because we are inside equilibrium right now. As you can see this box right here, we are in equilibrium. So if we break out from either side, so there's two main scenarios that can happen. The first is you break out, like a true breakout. So a breakout that is tested or defended. I like to say defended. That tells you that this is a true breakout in one direction. Or you can get faked out, right? So where it goes in one direction, but actually it's just doing that because it wants to reverse in the other direction. So those are the two things you're always aware of as traders. But the key thing is I can see we are in equilibrium. So I can either go to a lower time frame and start to build my trades from there and anticipate what will happen on the higher time frame. So the equilibrium is the calm before the storm. And I'm going to illustrate that using the NASDAQ. Okay, let's go there. Look at this daily. Would you prefer to be involved in trade here or here? Of course, here. This is the calm. And then this is the result of that calm, the storm. Let's go to the 1 hour. Look at this. Would you prefer to be involved in this move or here? Or here, because this is the calm before the storm. Look here. Would you prefer to be in this calm or when price had already moved? Well, here, this is the calm. So what the equilibrium is doing, in simple terms, if you were thinking, what is the takeaway from this video? If I could take something away from this video, what is that? If you could identify the calm before the storm, would you think that was of any value at all? Let me know in the comments. So if you found anything interesting or you got any insights, please like the video. And if you want to see more videos like this, please subscribe to the channel. Thank you very much for watching. I'll see you in the next video.